we did an analysis and modeled out a stress case for $50 oil in the event that the 90-day tariff pause expires and tariffs come back in full force. We think this would, this will obviously hit cash flow significantly by a quarter to a third year over year for this group. And as a result, we believe that the buyback programs would effectively nearly be fully eliminated for the year.
By the end of March, storage in Europe was 34% full. So that's versus 58% the year before. So that's quite a gap, and that's mainly because of the weather. Adjustments in weather. Just we didn't have that luck of having a milder than average weather this past winter. And what that means is that Europe needs to, according to our calculations, needs to import roughly 140 billion cubic meters this year. So that represents roughly a 30% increase versus last year.
We think natural gas, because of what Patricio and Will can tell you about LNG overseas needing to be refilled and what that means for U.S. opportunities on LNG growth, what you guys wrote about in terms of AI and cloud computing and the capacity for growth there as natural gas becomes an important feedstock in the power stack. So in general, we have some near-term pressures, but if I take a look at the valuations in general, they seem to be pretty decent.
Enphase reported last night. If you don't know Enphase, they are a inverter manufacturer. So basically, if you have solar panels on your roof, Enphase could be one of the companies that supplies the inverters to convert the DC power into AC. And we heard a lot about tariffs on that call. If you think about their specific company, what they're seeing is kind of a 2% gross margin headwind in 2Q, and then a 6 to 8 gross margin headwind, 6 to 8 percentage point margin headwind in 3Q. Now they're a pretty high gross margin company for an equipment supplier. Their 1Q gross margin was about 49%. So they're still a quite profitable name. Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we've got Will Hares joining from London, then swinging over to Madrid. We've got Patricio Alvarez, and then across the ocean, we've got Vince Piazza and myself. Just looking at the screen right now, it looks like Brent crude's about $67 a barrel and change. And I think we're still in this dynamic of talking about tariffs and what the read across could be into the general economy, oil markets, and all sorts of things. And Will and Vince, you both have some very interesting pieces of research out talking about the implications of tariffs on the energy majors and E&Ps. So Vince, we'll come to you first. You basically took a look at your coverage and kind of worked through the risk that a downward trajectory could pose for E&Ps, whether it's buybacks, CapEx cuts, these kinds of things. So kind of tell us about your general thinking on how this continued discussion around tariffs might feed into your space.
Well, a lot of it is geared around sentiment, right? Sentiment has a way of rolling downhill and becoming reality. So before all of this came to pass, when we looked at our space, natural gas had really stepped up big. And when we looked at free cash flow and EBITDA to kick off the year, EBITDA was going to be strong if trends continued. We were looking at double-digit growth in EBITDA, a near doubling of free cash flow because CapEx was also going to be down some, just because of the tighter reins that the industry had. Going forward, nat gas took a massive downturn. The one biggest loser in all of this is M&A, right? M&A was where the interest was. The limited interest that existed in this group was geared around M&A, and M&A mainly on the oil side. So our call coming into the year was because of the uplift in nat gas that we would see some catch up on deals for nat gas focused players on the heels of Chesapeake and Southwestern getting together. We were all good until April hit. We took off over $1 on nat gas just in a matter of 3 weeks, 4 weeks, and that's mostly because of the seasonal lull as we went from heating season into spring shoulder. But we still think that in general, nat gas becomes the advantaged hydrocarbon more broadly, whereas downstream demand for liquids is much more challenged. We think natural gas, because of what Patricio and Will can tell you about LNG overseas needing to be refilled and what that means for U.S. opportunities on LNG growth, what you guys wrote about in terms of AI and cloud computing and the capacity for growth there as natural gas becomes an important feedstock in the power stack. So in general, we have some near-term pressures, but if I take a look at the valuations in general, they seem to be pretty decent. They're right around the average mark relative to history. We're looking at the 5-year rolling averages on the natural gas side. So I haven't given up hope yet. Of course, we like certainty in the marketplace, right? We like the clarity, the transparency of policy. We haven't really seen that yet. It's almost a self-inflicted pain, it seems, because we were in a pretty good spot. So I haven't given up hope yet, but I think the crude oil names are much more challenged than natural gas names, even taking tariffs out of the equation. But obviously, tariff side is really impactful on the downstream demand because we're looking at a recession. We're looking at less downstream demand, less travel during a very key part of the seasonal cycle, which is summer travel season here and also overseas as well.
Yeah, Will, let's get you into the discussion here. Do you agree with Vince's view that the more oil-weighted names have more at risk? And I'll just note you had a pretty compelling note out, I think it was last week, talking about some real risk to buyback programs for some of the European oil majors. So walk us through your thesis there.
Yeah, thanks, Rob. So just quickly on gas, yeah, I do agree with Vince. We've actually already seen it over here in Europe. The more gas-weighted upstream independent E&P names have fared relatively well, although they've also been hit quite hard, and that is largely due to we had a pretty cold winter here over the last, particularly for January, February. And storage draws, and as Vince mentioned, they need to be refilled over the summer. So I think that relative to oil-weighted names is probably a slight harbor from the storm, I would say, within European E&P. But notwithstanding, there's obviously very intense pressure just broadly on the pricing backdrop. And yeah, on tariff related impact for the European majors, we did an analysis and modeled out a stress case for $50 oil in the event that the 90-day tariff pause expires and tariffs come back in full force. We think this will obviously hit cash flow significantly. by a quarter to a third year over year for this group. And as a result, we believe that the buyback programs would effectively nearly be fully eliminated for the year. Now, that's not including 1Q. 1Q buyback tranches are being deployed as we speak, but we think if these tariffs do come back in force, management teams will effectively be forced to fully suspend their buybacks. Obviously, directionally negative for the group, but this is sort of what the buyback plans are designed around. They are the flexible variable component to the distribution frameworks for these companies, and they're also there to sort of protect the dividend policy, which we think can remain resilient across the group, and it would require a significantly lower drop in and sustained drop for Brent oil, likely down to the $40 or below range before these names take a look at their sacrosanct dividend policies.
Very interesting, Will. So $40 is the sort of real difficult case where even the dividend gets at risk. Okay, Patricio, a lot of discussion from Vince and Will on the gas side of the equation. You've got several notes that are of interest on the European gas market, including one out just this morning. I think your one from today is LNG frenzy builds as Europe faces 2025 gas storage squeeze. Tell us about that note, and let's hear your view. Is gas a bit of a safe haven here at the moment?
Sure. So I would start by echoing Will's comments on the storage draw. So by the end of March, storage in Europe was 34% full. So that's versus 58% the year before. So that's quite a gap, and that's mainly because of the weather. Adjustments in weather. Just we didn't have that luck of having a milder than average weather this past winter. And what that means is that Europe needs to, according to our calculations, needs to import roughly 140 billion cubic meters this year. So that represents roughly a 30% increase versus last year. And since we lost Russian gas flows via Ukraine, so that's 15 VCM that we lost there. And since we don't have any other alternatives, because domestic output is declining or is in structural decline, that means that we will need to pull LNG very hard. And the main commercial partner there is the US. And I would say before the trade, the trade war started, I think the outlook for natural gas in Europe wasn't that negative. We thought prices between 45 and 50 euros per megawatt hour were possible because the industrial outlook in Europe wasn't looking too bad relative to the previous years. And after the tariffs, of course, we've seen this story change. And I think it's important to note that one of the main drivers there was Chinese demand. So China has consumed much less LNG this year, roughly 20% less year to date versus last year. So that is considerable. And that is before considering the tariff impact. So according to my calculations that I just looked at the numbers now, roughly it's been 70 days that China hasn't imported LNG from the US. And though that's not a big chunk, like if you put it into context, China only imported around 9 BCM of US LNG in 2024. So it's not a big, let's say, it's not a big chunk of the imports that we need, but it will definitely ease the balance. So if you think about the two, I guess, drivers, is that we do have a larger restocking gap this year. But we think, if anything, Europe may actually miss its storage target of 90%. Even though the LNG pool is wide and all that, there's really the the seasonal spreads in prices are very thin, which means that operators are not incentivized to restock inventories at the moment. So that means that perhaps we will miss our target and just reach around 83% full by the end of November versus the 90% target. That doesn't mean that we're in crisis, but if anything, it tells you how much uncertainty there is out there about where those trade flows for LNG especially will end up going.
Yeah, I always have to check the numbers on European gas to make sure I'm doing the conversion right. But it looks like TTF's at about little over $11 per MMBTU, sub 3 here in the US for Henry Hub. Curious, just quickly, given, I still see that as a relative premium for pricing. What's the impact of that? Are regulators pushing back on passing through those higher effective LNG costs onto consumers in terms of electric power rates, gas utility rates, that kind of thing? Or is it copacetic? Everybody's okay with the sort of higher cost basis?
So I think there's still a significant drag on energy consumption in Europe. So if you look at what we had during the energy crisis, it was almost it was a blanket sort of subsidy for both households and industrial power and gas use. At the moment, subsidies have been rolled back significantly since 2022, and that's across the board. And not only gas, it's just for renewable energy as well. Subsidies have been rolled back, and at the moment, we only have very, very specific, very targeted industrial or heavy energy user type of subsidies, but they are not very large. So if anything, I guess the answer to your question is there's not a lot that regulators have been doing in the past 12 months or so to ease the impact on industry and households, at least not anymore. Right now, TTF is at around 34 euros per megawatt hour, which is still roughly 1.5 times what it was before Russia's invasion of Ukraine. So there's still a significant drag, but I think regulators don't have the firepower anymore to subsidize energy use as we did before.
Okay, fantastic. Let's shift gears a little bit and maybe talk about the 1Q earnings cycle. And I'll just give a quick anecdote. So most of my companies haven't reported yet, but Enphase reported last night. If you don't know Enphase, they are a inverter manufacturer. So basically, if you have solar panels on your roof, Enphase could be one of the companies that supplies the inverters to convert the DC power into AC. And we heard a lot about tariffs on that call. If you think about their specific company, what they're seeing is kind of a 2% gross margin headwind in 2Q, and then a 6 to 8 gross margin headwind, 6 to 8 percentage point margin headwind in 3Q. Now they're a pretty high gross margin company for an equipment supplier. Their 1Q gross margin was about 49%. So they're still a quite profitable name, but these are real impacts from tariffs. So a lot of discussion there, and I think particularly in the clean energy supply chain, a lot of the 1Q readout and look ahead is going to be very policy focused, very tariff focused. A lot of discussion about what happens with the IRA and tax incentives here in the U.S. But I want to check the pulse from others on the team. So Will, let's bounce back over to you. Can you give us a sense of give us the earnings preview for 1Q for your names?
Yeah, so I think it's looking slightly bearish. I mean, I think 1Q actually won't be so much the focus. I think after 1Q results, everyone will be just looking through the windshield at the rest of the year. So I actually think 1Q should be okay, given some of the liquids price strength we saw in January, February, and easing a bit in March, but April obviously has come to a bit of a shock to the not just the global energy system, but all of global trade. So I think 1Q is sort of going to be a bit of a misnomer as far as 2025 is concerned. I do expect to see some more developments, specifically on strategic clarity for the European energy majors, notably from BP, who had a strategy day in February. This was met with some consternation from investors. As we know, Elliott Management has built up now a 5% stake in the company. They are not happy with how management has executed on their strategy. As we have been writing for quite a while now, that their rapid and risky energy transition pace risked their returns, and I think we're actually starting to see some of the knock-on effects from that now. Their capex has been way too high, their costs have been too high, and so I wouldn't be surprised to see BP management go further than they did at their strategy day, announce strategic review maybe for some more of their energy transition related businesses. This could be BP Solar. This could be some of their wind portfolio, maybe biofuels. We think that BP really needs to do more on their balance sheet. It's the most leveraged of all of their peers. And of course, they've also slashed their buyback for this year in half, which we think could go down, could be revised lower as well. And then just on top of that, there's a lot of management concerns around management's execution. And we saw this recently at their AGM, where BP saw the largest shareholder revolt against a sitting FTSE chairman of the board, with 25% of the shareholders voting against his re-election. So that's a pretty good temperature reading of how frustrated BP investors are, and I think you can see that in the share performance and the yawning valuation gap that BP's at compared to their peers.
Did I hear that correctly, Will? Are you basically suggesting that BP might further retreat on some of its energy transition spending? And also, just maybe a sort of tangential question on Equinor. Just last, I believe it's Friday, the Trump administration hit the brakes on Empire Wind. That's the project off the coast of New York. I'm pretty sure that's Equinor's project. So, is that something that they're also wrestling with in terms of their transition capex?
Yeah. So just first on BP. Yeah, absolutely. I think this is the prime area in which BP could dial back their ambitions. They've been way too aggressive and way too risk accepting in some of their energy transition investments, and that also sits with what Elliott Management is wanting. The number one thing that Elliott Management wants is to reduce exposure to the energy transition and lower return businesses while bolstering the balance sheet. And so how you do this is by selling off stakes or full businesses that are energy transition oriented. So yeah, that's what we would like to see from BP. Is it the be all end all solution? No, I don't think it is. But getting back to a more simplified business model of oil and gas, which is what this company has been built on. Not doing away with all of energy transition, but moderating their exposure significantly to bolster returns. And yeah, on Empire Wind and Equinor, I think Equinor has actually, from a energy transition standpoint, a strategy standpoint, they have navigated it relatively well, I think, compared to their European peers. They were early movers on large projects and sold down interests very early on, including to BP. helping bolster their returns in this area. So I think their portfolio strategy here has been quite effective, and it's quite unique in the sense that they are nearly fully exposed to offshore wind versus their peers, which are vast majority 75% or more weighted to solar versus wind. But I think as Pat could tell you, the offshore wind sector has been beat up pretty bad from a toxic combination of high interest rates, supply chain issues. Now it's become sort of a political punching bag, I think, by the Trump administration. So it's I expect there will be more restraint being showed in offshore wind spending, not just from Equinor, but from all of the peers.
Yeah, let's get you into that conversation here. So, what do you make of what Will just said? I kind of tend to think of there being a bifurcated market here where, we're probably really truly hitting the brakes in the US, and maybe there's still a more cautious approach unfolding in Europe. Europe certainly has very aggressive offshore wind targets. Let's get your read on that, though. What's offshore wind look like here at the moment in your perspective, Patricio?
Sure. So we cover Ørsted here in our European utilities franchise, and I think that's the poster child of what's going on with the offshore wind sector. I would say globally, outside of China, perhaps, but most notably in the U.S. So we do think there could be negative read across for other projects. I think it's important to note that our original thesis was that projects that were already under construction and had secured federal permits, such as Empire Wind, would be safe under a Trump administration. But this clearly, raises the bar in terms of regulatory uncertainty. So this opens the door for more impairment losses, I think, particularly for Ørsted. The company exited 2 projects in 2023, and that, carried multi-billion losses for them. They still are on track to build two more projects, Revolution Wind and Sunrise Wind, set to start in 2026 and 27. So those projects could be exposed to these type of delays. Iberdrola also, they also have a project there in Vineyard Wind. That project already reached first power, but still on the process of ramping up. But yeah, to your point, in the US, I think offshore wind across the peer group, so we're talking about ENGIE and EDP and other power generators that have really pared back their investments in offshore wind, particularly in the US. And it's not only offshore wind. I think uncertainty over the Inflation Reduction Act and now tariffs has actually led to a lot of European developers to pare back investment in all the technologies. So that's solar, onshore wind, and now they're only committing to sort of finishing whatever backlog that they had under construction. So really, the growth pipeline for European developers has been significantly reduced in the past 6 months or so. And to your point on offshore wind in Europe, in Europe, we do have very ambitious targets, but outside of the UK and perhaps the North Sea and the Baltic Sea, there is not a lot of activity in terms of offshore wind. It's not a technology that is growing exponentially. We're talking about a handful of gigawatts per year. When you compare it to solar, for example, in Europe, it's growing at a much more rapid pace. So offshore wind, just by the longer lead times, is these projects require 5 years almost only in permitting and could take up to 8 years in total to get built. So if you compare it to solar, which can be built in 12 months, utility scale solar, I think that's the answer. Offshore wind is struggling, I think, globally.
Yeah, very interesting. Yeah, mea culpa on my part as well. I agree with your view that typically once you're kind of at the construction, fully permitted phase, it's very atypical to sort of hit the brakes like we saw with Empire Wind, and I suppose we're having to revisit a lot of our sort of general assumptions on how that kind of stuff works, and not just America, but elsewhere as well. I'll just quickly observe too. Nordex is one of the European wind manufacturers, and they're exclusively focused on onshore. And I think probably 3 to 5 years ago, they would have been getting beaten up a little bit, kind of saying, why aren't you doing offshore as well? Where's your offshore offering? And they just kind of put their head down and said, we're an onshore only company. And kind of interesting to note, they're up about 40% year to date. Variety of factors kind of feeding into what's going on there, but the fact that they don't have complex offshore projects, muddying their thesis could be part of the story there. Vince, let's flip over to you. I want to get on back into the more molecule side of the equation. Give us a sense of what you're anticipating for the 1Q readout from your names.
Yeah, so I think 1Q is probably in the rear view mirror for a lot of folks right now, just because of uh, the tariff tensions and the tariff turmoil and how that'll affect 2Q going forward. I mean, Q1, we're gonna hop on the conference calls this morning and get a sense, get a feel for what EQT and Range are saying. But I think in general, the quarters for those two were pretty benign. Range bought back some more stock than we would have anticipated. EQT surprisingly did a bolt-on deal that was kind of cheap. They got it at a good price, but there really wasn't much there to hang your hat on in terms of any kind of momentum for 2025. These are the two key flagship names on the natural gas side because of their exposure to Appalachia. So I would put them aside, really. But I think in general, you're still going to see a great deal of capital discipline, and maybe even more so. I just wonder who's going to be the first guy really to step back and say, hey, you know what? It's time to take a much more aggressive tone here and reduce the capex because, at $3 and at a 60 some odd handle on WTI, you're coming very close to levels where you have to rethink the budget, looking at the tier one acreage and refocusing your attention on that. When we were in the 70 and the 350, almost $4 on gas, you could probably get a little more aggressive. But even coming into 2025, there really wasn't a lot of growth baked into these numbers. So I think the operators are really just focusing on uh, meeting the investors where they want to be, and that is the capital discipline and return of excess cash. So I'm feeling okay right now. I need to see us hold $3 on gas. I need to see us hold $60 to get me through the spring, and then I'll come back to you after summer recess and give you a little more clarity, a little more transparency there. So I'm not hitting the panic button yet.
All right. Thank you so much, Vince. And Will and Patricio, I think we'll leave it there. For everyone who's still on, just a reminder that we hold these calls every Wednesday at 10 a.m. New York, 3 p.m. London. We rotate through the team here with BI, occasionally have an external guest. If you've got someone you think we should have on, just shoot me an IB or send me an email, and we'll see if we can make that happen. And if you got any topics that we didn't cover, you want to hear us talk about or follow up individually, we're all green dots on the terminal right now. So just shoot us an IB and ask us any question that might be on your mind. Take care, everyone.